Everyone is worried about inequality. In the United States, starting in the mid-1970s, workers have lost economic power. We call this the labor squeeze, and it is the result of 5 main trends. The labor share, that is the share of GDP paid out in wages, has been decreasing since the early 1980s. There is no sign that this trend is reversing. And this means that the capital share, the share of GDP going to companies, investors, and their asset managers, has been soaring. Wages have been stagnant since the late 1970s. Between 1979 and 2020, hourly pay only grew by 17.5%, while productivity increased by 61.8%. That is 3.5 times as much. Without this disconnect, a salary of $40,000 today should be closer to $61,000. Wage disparities are increasing. More income is going to the top 1% of earners and less to the bottom 50%. Between 1975 and 2019, the share of income captured by the top 1% of income earners increased from 10.4% to 18.8%, while the share earned by the bottom 50% dropped from 19.4% to 13.3%. A typical CEO went from earning 30 times the salary of an average worker to 250 to 350 times, while people earning the minimum wage have actually lost purchasing power since the 1970s. Risk is increasing for workers. Earnings volatility has risen, and substantial fluctuations in family income have become the norm for American households. This, of course, was exacerbated by the recent COVID-19 crisis. Labor markets are more precarious. An increasing share of workers are facing alternative work arrangements characterized by unpredictability of working hours, little to no job security, low wages, contingent work, and no benefits. The share of alternative work arrangements increased from 10.7% of workers in 2005 to 15.8% in 2015. How did we get here? Factors like technology, globalization, outsourcing, failure to invest in education, and the decline of unions have combined to keep workers' bargaining power low, particularly in the U.S. The structure of the economy has also been changing, such that profits are increasingly going to a shrinking pool of well-compensated workers and firms. In an environment of slowing economic growth beginning in the mid to late 1970s, strong corporate profitability was achieved through corporate concentration, with the domination of a few superstar firms gaining a very large market share across a range of sectors. The rising role of intangible capital, like data or intellectual property in the economy, and low investment, about 10% lower than it should be given profits and valuations, freeing up cash to return to shareholders through dividends or share buybacks. These structural trends have resulted in a kind of two-speed economy, where a small number of firms and workers are getting rewarded with an increasing share of the economic pie. These firms drive down the labor share because they employ a very small number of employees relative to the value that they capture. They are also able to restrict the pool of highly compensated workers through the use of outside contractors, or, because of their market dominance, by squeezing wages for low-skilled labor. Economists call this monopsony. The Fed's continued injection of massive liquidity in the economy to lower interest rates in response to financial crises has exacerbated those trends. Cheap corporate debt has magnified returns for investors through leverage, even if it meant increasing the risk of bankruptcy and cutting costs like payroll and benefits. Debt has often been used to fund financial engineering, stock buybacks, dividends, and leveraged buyouts rather than internal investment. It has also contributed to mergers and acquisitions, corporate consolidation, and monopsony dynamics, as well as fueled asset price bubbles, including in financial markets and real estate. All this is not only responsible for squeezing workers and the inequality we currently see in the U.S. and elsewhere, but also creates systemic risk for investors, lenders, and society. Watch our next video to learn more about these investment structures and the risk they pose, as well as how we might build back better our already fragile financial system after the COVID-19 crisis.